where to invest to become a millionaire? There's this forever debate when it comes to the investing world: real estate or the stock market? And it never seems to end. The stock market investors will always point out how great the stock market, such as the unbelievable rate of return you could have in a single year, while real estate investors will point out the cash flow that the real estate provides. Each of these groups is right. Both real estate and the stock market have their pros and cons, and the truth is somewhere in the middle, as always. If you were a stock market investor in 2020, it doesn't matter what stocks you invested in. You most probably made an incredible rate of return. If you had invested in tech companies, you probably doubled or tripled your money within a year. And if you were a real estate investor, you probably didn't do much. Property prices increased by around 12%. That's nothing compared to how much the stock market rose. But in the context of real estate, 12% is a lot, because the real estate market usually grows by 2 or 3% at best. So let's look into this confusion. Where should you invest your money in this year 2023? Is the stock market better than real estate? Or is the real estate still the greatest investment you can ever make? If you have $50,000 or $100,000 that you saved up, where should you invest it? You're gonna get answers to all these questions in this video. Just stick to it till end. Now let's dive in. When you buy a stock, it's just a digital document on the screen of your smartphone. You almost have no control over it, since your single stock isn't going to give you much influence. When the company has another 5 or 10 billion stocks, while real estate gives you complete control over your investment. Even if you have taken a mortgage to purchase it, you can touch it, feel, and control it. What sets real estate apart from other types of investments is leverage. With $50,000, you can control $50,000 worth of stocks. But when it comes to real estate, with $50,000, you can control $500,000 worth of real estate. No matter how big a fan you are of a stock market, the fact is that you have a very little leverage for the stock market. Of course, there is something called margin investing, where you can borrow from your brokerage firm to double or triple your income from the trade, but it's not as much as real estate. On top of that, margin accounts are usually used for trading and not investing, since the interest you have to pay on the borrowed money is pretty high, while in real estate, you can get a decent mortgage rate for 30 years, especially now. There is also another very important thing to consider: the cash flow. Have you ever heard the term the king of dividends? These are the companies that are within the S&P 500 that have been increasing their dividends for the past 50 years or more. Think about it. 50 years is a long time. Booms and busts, inflation and deflation, high interest rates and low interest rates. These companies have survived and proposed through it all, and kept raising their dividends rates year after year. One such company is Johnson & Johnson. Guess how much dividends does it pay? A little over 2.5%. And besides, the stock price did not even increase by 50% in the last 5 years. While when it comes to real estate, you can get 7, 8, or 10%. It all depends on the neighborhood and the property. So if cash flow is more important to you, then real estate is the option to go with. However, the problem with real estate is it's nearly impossible to have such a high growth, like you could have in the stock market, unless it's a bubble. Sometimes a company enters the game and revolutionizes the entire industry, and a $10 or $20K investment in that company could worth millions in less than a decade. Netflix is a great example, but it's just one out of many. Netflix stock price since 2012 rose by over 5,730%, which means every $1,000 that were invested in Netflix back then, now worth over $57,300. In other words, if you invested just $18K in Netflix in 2012 without doing anything else, you would have become a millionaire today. The stock market is filled with such examples. When it comes to growth, the stock market undoubtedly wins. But to invest in the stocks, you need to be emotionally stable. Otherwise, the stock market isn't for you. The market jumps up and down every single minute. Sometimes it's all over the roof, rising like there is no tomorrow. And if you can't control yourself, you will start buying more when you shouldn't, since that plunge will be followed by a correction. And vice versa when the stock is falling for a few days in a row. You have to understand that this is temporary and be patient. But one thing about stock market is that when you invest in a certain company, especially if it's a safe investment in a huge company like Apple, you do not feel like you own something. Of course, theoretically, you're one of the owners of the company. But how much your 10K, 20K, or 100K dollar investment in the company really worth? How much deal wealth does it provide you when the company worth over $2 trillion? While when it comes to real estate, you own the entire thing. What we also have to consider are taxes. If you make $1 million and the government takes half of that, such as in the case of income tax, when you're not making $1 million. And that's where real estate also wins over the stock market. When your stocks rise in value, remember that you're only getting wealthier on paper. If you want that wealth to turn into real money that you can spend on yourself or buy another asset, then you have to sell your stocks and pay a capital gain tax, which is 20% of the long-term investments and can go as high as 37% of short-term trades. With real estate, there are multiple ways to avoid taxes and use that cash to grow your wealth. For instance, instead of paying for the entire property upfront, you can deduct a portion of your mortgages attributable to interest payments on your tax returns. You can recover the cost of income-producing rental property through depreciation. Depreciation expense often results in a net loss on investment property, even if the property actually produces positive cash flow. This loss, as well as expenses, such as utilities and insurance deducted from ordinary income. Even if you end up selling the house, you can avoid paying capital gain tax. If you purchase another property that's bigger, tax incentives in real estate are unbelievable. It seems like real estate investors wrote the tax code. So now we know all the ups and downs of both the real estate and the stock market. And in many ways, real estate looks like a good deal. But the question is, what's the best investment now, this year? Well, the answer is a bit complicated. Real estate is a great investment, especially when mortgage rates are low. Even a single percentage is going to play a huge difference in the long run. So with mortgage rates now around 3%, it's definitely one of the best times to take a mortgage. And for the past year or so, everyone who's saved up for the down payment did take a mortgage. The Fed was so afraid that the pandemic will stop people from buying houses that it lowered mortgage rates from almost 5% in 2018 to 2.6% by the end of 2020. But that reaction in mortgage rates led many people to take mortgages to the point where home prices rose significantly. As we have discussed earlier, home prices usually rise by 2 or 3% just to match with inflation. However, in 2020, in the middle of a pandemic, when most people lost their jobs, home prices rose by 12%. That's why many economists predict a certain correction. But that's just a prediction, because we're not out of this pandemic yet. And the Fed might keep mortgage rates low for another few years. Everyone who couldn't take a mortgage in 2020 will do that this year, and in the next few years. So there's a very good chance the home prices will keep rising for another few years, as long as interest rates are low. The same goes for the stock market. During the 2020 crash, the Fed stepped in and flooded the market with cheap money. It started buying junk bonds and even lent money to the largest corporations such as Apple or Microsoft. Most of the companies should have suffered last year, but the Fed chose to inflate the market to prevent a deflation. Of course, that's great. But what happens when the Fed increases interest rates or stop buying corporate bonds? Most of these companies will start suffering. So the market could witness even bigger correction compared to what we have seen in the last few weeks. But according to the Fed, it plans to keep the interest rates at the bare minimum for a few years until the economy is back on its knees. How long it is going to take, or will it happen or not, only time will tell. Thanks for watching, and until next one.